is the return contribution. Risk budgeting, we're looking at risk contribution. How is this done? We don't have to worry about how that's done in this learning objective. You want to know how that's done? That's the FRM. So let's get back up to the top here. We left off with finally defining risk budgeting here. We have types of risk measures, single dimensional risk measures. Dimensional risk approaches. Single dimensional risk approaches, standard deviation, beta, value at risk, and there's a whole bunch of variations of value at risk. There's marginal VAR, component VAR, incremental VAR, relative VAR. Marginal VAR is how much extra risk you're taking on per extra dollar. Component VAR is what happens when you delete one of the components. Does the risk profile change? Sometimes by deleting a component, you can actually raise the risk of whatever's left. Incremental VAR is what happens when we add a particular asset or a particular project to the overall risk. And relative VAR is the value at risk versus some index. And again, if you want to know more about this, FRM will lead you through the whole thing, right? Multidimensional risk approaches. And this is something called, if you ever heard the term, portfolio margining. And so let me see if I can explain that. Typically, what retail investors used to experience when they had brokerage accounts was position margining. So that every position had a particular margin requirement. You took another position, it had its own margin requirement. You took another position, it had its own margin requirement, on and on. That's called position margining. Portfolio margining works this way. You have one position with a margin requirement. You add another position, it has its margin requirement. But it also looks at the interaction between those two positions. And if the correlation between those assets are extremely low, such that it lowers the risk of the overall portfolio, you don't need a margin requirement on each position. You just need one margin requirement now called a portfolio margin requirement, because a movement in one direction would benefit one while it would hurt the other. That's called portfolio margining. Typically, it was only available to very large players, so that the small players really had position margining. But now, most brokerages, especially interactive brokers, I know that specifically, if you have a certain amount of money in your account as a small retail broker, you will get portfolio margining, which allows you to take on a much wider range of positions than you normally would if you had position margining. That's called a multidimensional risk approach. Risk is evaluated based on the risk profiles of the underlying classes, and how they interact with each other, as opposed to taking one position and saying, there's the risk, here's the margin that you need, taking another position and assessing the risk, saying, here's the margin, another position, here's the margin. It looks at, well, how do these interact together, all together, and we'll just have one, we'll get rid of all these little ones and just have one that covers everything. So that's a multidimensional risk approach. LOSF, keyword identify. Identify financial and non-financial sources of risk and describe how they may interact. So, all right. Most of these risks, especially the financial risks, we've seen. If you've been through FRA and fixed income and equity analysis, we've seen all these risks, but we'll go through them nice and quick. Market risk. Changes in interest rates, stock prices, forex, commodity prices. The drivers of market risk typically are fundamental economic conditions, industry or company events. Credit risk, which is default risk or counterparty risk when one party fails to pay or perform an obligation. Not paying your coupon payment on your bond, just not paying your bond. The drivers here tend to be economic weakness or drops in demand. When economic weakness hits, what happens is a lot of your weak players end up defaulting. So there is, you can see the combination of risk. There isn't credit risk in isolation. You have market risk, And that will increase, as market risk increases, that will also increase credit risk as well. Third, we have liquidity risk, which is a transaction cost risk. Now, this is it's an unfortunate use of the word liquidity, but when you try to think of an alternative word, there really isn't. You can think of liquidity in two ways. Liquidity in terms of I got money to pay my bills. I'm not going to run out of cash. I have no cash flow problem. You can also think of liquidity as I got to sell something, but there's no ready market for it. So we can think of a private business as an illiquid investment. The private business may be very liquid in its own business, but selling the business is an illiquid proposition, right? That's what we mean by liquidity risk here, is having to sell an asset below fair value because maybe there's no market. The drivers here, widening bid-ask spreads in times of market strain. If you've ever tried to sell something in a fast-selling market, those bid-ask spreads, they gap. They go really wide. So you can get out, but that's crossing the spread. Ouch. Changes in market conditions or the market for a specific asset. And the size of the position. If you got to move a big position into the market, you're probably going to move the market, or the market just might not be there to absorb the size that you want to sell. Non-financial sources of risk. Settlement risk, and this is called Herstatt risk, and this was new to me. I looked at Herstatt and I said that I don't recognize that term, so I looked it up. It was a German bank in the 70s, and this is what happened. The German bank got paid to do something, and once it received the money, the German government stepped in and shut the bank down. It didn't perform. So imagine paying a contractor to fix your roof. You pay the contractor, and the contractor just doesn't show up. You would think isn't that default risk or counterparty risk? Well, no, it's not. Default risk or counterparty risk, in terms of how it's defined in finance, is there's an obligation that somebody has, and they fail to perform. So, for instance, you enter into a futures contract or a forward contract. You didn't have to send any money to the other side. You just entered into a forward contract. 3 months later, you're in the money. The other side owes you the money. Again, you didn't have to pay them for anything. They just owe you. They lost the bet, but they don't pay. That's counterparty risk. Settlement risk is you pay somebody to perform something and they simply don't perform. Now you're out the money and you have no performance. So that's called settlement risk or Herstatt risk. A party fails to deliver even though it has been paid. Continuing on with our non-financial risks, you have legal risks. Being sued. Number one, you could be sued for something. Perhaps it was environmental, perhaps it was a safety issue. We can think of BP or GM in these cases, who knows, but it's a risk, right? The other risk is not just the being sued part, it's not making the legal argument. Now, I want to take a moment here because I think there's a valuable lesson here. When you step into a courtroom, you need to get it out of your head very quickly that is not a court of justice or a court of fairness at all. If you're looking for justice and fairness when you walk into a court, you're going to lose. You are walking into a court of law. You must make the legal argument, not the just or the fair argument, but Your Honor, it's not fair. That's not a legal defense. That's not a legal argument. So you could be on the right side of the contract. The other side could have defaulted on that contract. You could be absolutely right, but you go into court and you fail to make the legal argument because the other side has made a better legal argument of why they didn't perform. And you'll still lose. And you may leave there saying, but that's not fair. You didn't walk into a court of fairness. You walked into a court of law. Once the verdict is decided for you, then the judge decides what's fair and what's just. But you don't get fairness and justice until you win the legal argument. And my friends, justice and fairness is not free. It's very expensive. So a lot of people with a lack of money simply have to take it when they get screwed over because they can't afford justice and fairness. They can't afford to make the legal argument. So, not making the legal argument is a risk. Being sued is one. You can always win in court. You win, you get damages, you get costs. Hey, it didn't cost you anything, right? But if you don't make that legal argument, that's brutal. Compliance, another non-financial risk. Regulatory, accounting, or tax compliance, which includes something called injurious reliance. And I found out this the hard way with Deloitte. You go to a big tax firm and you give them your complicated taxes to do, because it includes a lot of market transactions, a lot of capital gains, losses, and dividends and interest income. And they do your tax return, they file it, and you just tip your hat and say, thank you very much, here's your check. Well, what if they're wrong? What if their so-called experts are idiots, as I experienced, and you get audited and the auditor says you did this wrong, you did that wrong, and you're saying, look, all these were done by Deloitte. You take it up with them. Guess what? It's not their problem, it's your problem. Penalties and fines and penalties and fines add up. That's called injurious reliance, where you rely on the expert advice of someone else to your own injury. That is a risk. Just because you hire an expert doesn't mean they know what they're doing. They just call themselves an expert, but that doesn't mean they know what they're doing. So that's a risk you take as well. Every lawyer you hire, every accountant you hire, you have to say, now, do they really know what they're doing? Because if the lawyer doesn't know, I won't make the legal argument. If the accountant doesn't know, I run the risk of getting audited and getting hit with penalties because they made a mistake, right? Model risk. Valuation errors from either a misspecified or a misused model. That includes something called tail risk, events in the tail occurring more frequently than expected by the model. And we model in the market risk and uncertainty with the normal distribution. And Nassim Taleb, who's wrote a great series of books on probability and the probability of the highly unlikely in terms of the black swan events. And his argument is that the normal probability distribution is the wrong distribution because it completely underestimates tail risk. In fact, he's saying that so many left tail events have occurred that the model says would never happen for 1,000 years, happen every 6 years. So he says, clearly, it must be wrong. Continuing on with our sources of risk, we have operational risk. And here we're really looking at internal elements, including people and processes. And risk from people come from two directions. Number one is the activities of people within the organization itself. People make mistakes, and those mistakes can be costly. Also, people steal. Some go out of their way to steal, and they could be stealing money, equipment, trade secrets, customer lists, whatever the case is. That's always a risk, which means you need to have some way to control that kind of activity. Processes. I'll get to the second issue about people in a second, but processes. And processes can break down, especially critical processes. Take a manufacturing facility that uses a just-in-time inventory system. And let's say there's a supplier that's not too far away, maybe 8 or 10 kilometers away, but has to take a particular stretch of highway. And the probability of that highway being backed up at any given time over the course of the year is 100%. So that over the course of the year, at least once or twice, that highway is going to be backed up because of an accident. Well, if that truck can't deliver those parts and that line has to be shut down, it could be as much as $1 million an hour to shut down a line at an auto assembly plant. So you have to worry about, well, okay, fine, I'm a just-in-time inventory system, but where are my suppliers coming from? What routes are they using? What alternative routes do they have in case that route is gone? What backup do we have in case that delivery can't be made? That's an operational risk. The other risk from people, I said there were two. The other risk from people comes with how people deal with those outside of the organization. And there is a legal term called called vicarious liability. I already talked about injurious reliance. It's called vicarious liability. And this is what this means. This means that an organization is responsible for its people even when its people are outside of the organization doing something. If they're acting in a capacity for the organization, they're still responsible, even if the person is doing something that is not organizationally required. Let me give you an example of a situation that actually did happen. An individual was out working somewhere on a power line, And somebody came by, and I don't know what happened, but anyways, a fight ensued. The guy came down from the pole. It was a utility worker, and they got into a fight. And he punched the other guy, and he hurt the other guy. I don't know the whole details of the story. I just know how it ended. Anyways, the guy who got beat up sued the company. Didn't sue the person who beat him up, sued the company with this argument, saying that the company had responsibility for how that employee was conducting himself, even if it's outside of the job. So the person is on the job working, then picks a fight with a passerby, beats him up, and the company's responsible. So your operational risk flows two ways. People do bad things inside the organization, and people do bad things outside of the organization as well. Solvency risk. And here we're going to use solvency in a way we would normally use liquidity. But every profession has its own language. Risk professionals call liquidity the ability to sell something quickly, and they call solvency the running out of cash. Whereas accountants look at running out of cash as a liquidity issue. So let's just be aware that there are slightly different words, slightly different meanings being used for the same words. Solvency risk, running out of cash. Also being unable to secure financing, that's running out of cash because you can no longer get it. Or not being able to roll over your debt. Well, now you got to pay it. Now you're out of cash, right? So we can look at risks at the or financial risks, look at non-financial risks, but individuals also face risks. What are the types of risks that we face as just individuals? Well, theft. Things can be stolen from us. Our health can fail. We can die. And we might have a lot of responsibilities behind us, a whole family. We can get into an accident where suddenly we can no longer work anymore. We have a certain amount of wealth built up. Well, we'd like to protect that wealth. So all of these can be dealt with insurance. And the reading goes into insurance in quite detail, or quite a lot of detail. I've avoided that. I didn't want to get into any of the discussions about insurance because I don't want to turn this into insurance. And I don't know why the reading would go so far into that. I really just want to keep it as the sources of risk. As far as risk mitigation for individuals, yeah, insurance is what's there. And you pay a premium and you get protection from these types of risks. And let's look at the interactions between financial and non-financial risk. I give you two examples here. Credit risk can be made worse by market risk. We've already talked about that, sometimes called wrong way risk or systematic risk. Also, concentration is an interaction. Owning a home in a one-factory town while employed at the factory and holding company stock in the pension plan. Look how concentrated you are. It's a one-factory town that you work at. You own a home. If that factory goes out of business, guess what happens? The value of your property drops, you're out of a job, and the company stock and the pension plan's worth zero. That's a lot of interaction effects. But if you look at each one in isolation, I own a home in the city. I work at this particular business. I have stock in a pension. If you look at them all independently, nothing much there, but all of them put together. And if you want an example for this, General Motors in Flint, Michigan. And I think there's one documentary out there called Roger and Me, done by, I forget his name right now, the heavier guy who always wears the ball cap, who did Bowling for Columbine. I'll think about it as soon as this video is over, but it's called Roger and Me, and it's a story about exactly this. If you want to see how all these interactions really come together, something called the Minsky model, or Hyman Minsky, who wrote this up sometime, I think, in the late 50s, early 60s, I think around that time. And it's called the financial instability hypothesis. And he had a hypothesis that we're not paying attention to all of the interactions that happen because of this of all of what's going on in financial markets. That when a problem happens in one place, it doesn't stay there anymore. It affects everything. So if you want to learn more about this one here in particular, I think there's one book, Stabilizing an Unstable Economy, or Stabilizing an Unstable Financial System, something along those lines. Really good book to read. It really highlights that all of the risks that you identify, they're connected, that when one risk happens, it's like ripples through the system. It starts increasing other risks as well. On our next learning objective now, LOSG, which is to describe. Describe methods for measuring and modifying risk exposures and factors to consider in choosing among the methods. So let's look at different measures first, and then we'll go into modifications. As far as different risk metrics we can follow, probability, standard deviation, beta, we covered this extensively in quantitative analysis. For standard deviation, let's just remember that was the normal distribution only. We assume no fat tails. And we're going to use portfolio standard deviation. Remember, risk at the level of the whole, not asset standard deviation. And beta is our measure of systematic risk. In derivatives, different metrics we can use, delta, gamma, vega, rho. And I don't want to go too much into detail about this because we're going to do 4 readings that cover derivatives and alternative investments. We're going to see more there, so let's leave it for there. But we'll just go over the basic explanation. The only one missing here is theta, but theta is not a risk metric at all. Theta is just the rate of change of an option price with respect to time. There's no risk there. There's no uncertainty. One thing I know, time is going to pass. The other thing I know is as you get older, time actually goes faster. Einstein said that was called relativity. I think I have that wrong, but I tell you something, it certainly feels that way. Anyways, delta is the rate of change of the price of the derivative with respect to the price of the underlying asset. So, in other words, how much does the price of the derivative change as the asset changes? Delta is also used for hedging a specific asset. We want to, if you want a perfect hedge, you want 100 deltas to hedge out the underlying asset. Again, I don't want to get too much into detail about that, but delta can have 2 uses. Gamma is the rate of change of delta with respect to a change in the underlying asset price. So delta is at a point in time, at a point, not in a point in time, sorry, but at a price, at a specific price of the underlying. As the underlying begins to move, delta will move with a certain percentage of the underlying, but gamma will change delta. As well. So gamma is the rate of change of delta. Delta is the rate of change with respect to the underlying. Vega is the rate of change of the underlying asset with respect to volatility. So as market volatility increases, vega will cause premiums and options to really blow up. And rho is the rate of change of the price of the derivative with respect to the risk-free rate or the interest rate. Rho is not really a big player anymore. The changes in interest rates are very, very few and so far between, and we're sitting on the zero line that Rho's really not a big deal anymore. Vega, if you're an options trader, Vega is the big one that you like to see come and go. You like volatility in the volatility, as they say. And bonds, our risk metric there that we looked at was a measure called duration. Another risk measure we'll introduce here is value at risk, just shortened as VAR. It measures the financial risk across all asset classes. It's expressed as a minimum extreme loss metric. And there's no maximum, it just sort of gives a minimum. So let's just think about, here's the distribution of profits that we can expect. And we might set a left tail limit and determine, well, how much can we lose? What's our value at risk over here? And it's expressed as in terms of 3 things: a currency amount, a probability, and a period of time. So we might say that $4 million at 3% for today. So in other words, that's the value we have at risk, is that there's a 3% chance that we could lose $4 million for today. That's how much we have at risk today. And then you have to ask, based on the size of our cash position, let's say that we have $100 million, are we willing to take that 3%? Is the value at risk suitable for us? And if the answer is yes, then you go ahead. If it isn't, then you do some modification. So you would have a VAR measure every single day for how much you have at risk on any one given day. Since VAR must assume a distribution of profits like it did here, it is subject to model error. Well, what if the normal distribution isn't a proper distribution? Then VAR will give you the wrong answer. To kind of make up for that shortcoming. There's something called extreme value theory. It attempts to overcome left tail shortcomings of the normal distribution. We're not going to get into it, but just be aware that if you see the terms extreme value theory, it is an extension of VAR that tries to say, okay, well, let's see if we can't have VAR, but get rid of this nasty distribution here, and let's look at it in a different way. Other techniques for measuring risk: scenario analysis or stress testing. We talked about scenario analysis briefly in quantitative analysis when we looked at Monte Carlo simulations and what was involved there. And that's a more robust way to do a scenario analysis as opposed to just saying, well, what if things were 20% better or 20% worse, right? Scenario analysis and stress testing used to complement value at risk. In the bond market, credit ratings or credit default swap pricing gives us some indication of what the credit market is pricing in terms of the risk it sees. Other types of risks that you would attempt to measure: operational, compliance, and legal. These are very hard to do. Think about legal for a minute. How would you quantify that? First, you'd probably get a legal opinion from in-house counsel as to, are we exposed here? Listen, you don't have to walk down to in-house counsel to ask them if you're exposed. The answer is yes. The answer is yes. As far as a lawyer is concerned, unless you're locked up in a room with no communication with the outside world, you're exposed. Simple as that. So the answer is going to be yes, you're exposed. But how would you quantify it? Difficult to quantify. Here you tend to use more subjective measures, and it's these subjective measures that are, well, how do you get wide buy-in for that? How do you incorporate that into a management system when you have to manage something that is not quantifiable but subjective? And look, even the quantifiable stuff is based on historical observations and historical events, and may not represent what happens in the future. So maybe it's not that bad. Risk modification. Great. We've talked about risk up to here, right? Let's look at, well, now what do we do? How do we deal with this risk? Well, let's start with risks we simply do not want, period. There is risk prevention or risk avoidance. Simply just stay out of the way. Those risks where the associated activities are just not worth pursuing. The risk is simply just too great. Let's take a jewelry manufacturer as a good example here. And the jewelry maker has had a policy of hedging out its gold. It didn't want any uncertainty in its prices out 6 months or 1 year out, so it would use hedges. Well, then it started moving away from a complete hedge to over-hedging or under-hedging, depending on where it thought gold prices would go. In other words, it moved from hedging gold prices to speculating on them. Well, suddenly there's a risk that has nothing to do with making jewelry. So this is something where you could step in and say, you know what, let's just not do it. Let's just avoid this particular activity. There you go. Done. Prevented. Avoided altogether. Well, the opposite of risk avoidance is risk embracing, right? So here it is. Risk acceptance is a strategy. Just accept the risk. And we can do that in two ways. We can self-insure or we can diversify. So self-insurance, let's look at that. Keeping the risk exposure, but using internal means to reduce fallout. So we may decide that the cost of hedging or the cost of insuring against a risk is too much, given the probability of the risk occurring, that by the time it does occur, and it will occur if in repeated trials, it will occur, that we could just take the money we'd pay in premiums, keep it, and it would pay for our losses anyways. Why pay somebody else to do it, right? So you keep the risk, but use the internal mean to reduce the fallout. So look at a bank in terms of its loan loss reserves. It keeps some of its money and says, well, we'll just hold this back because we know we're going to lose somewhere. We don't know where. We know we're going to lose, and this will cover off the loss. Diversification, reduce non-systematic risk. So whenever we buy a particular asset, we have what's called non-systematic risk, or risk specific to that asset. And as we add more assets, we can diversify away, which means that we can remove the non-systematic components and be left with nothing but systematic risk. So that's something we can do ourselves. Risk transfer. We have risk. We can transfer it to someone else. typically in the form of an insurance policy. You pay a premium, you protect against losses. So in the financial markets, this would be the same as buying index puts. So let's say I have $500,000 in a stock portfolio position, and my portfolio has a beta of 1. Well, at that point, all I have to do is find is get some index puts that equal the value of my portfolio and buy puts on the index. There, I'm insured. So if the stocks in the index start falling, I don't have to sell what I have. My insurance will pay off for me. I pay a premium and I protected myself. Think of any insurance policy you have. Auto insurance, home and fire insurance, all of that. Well, that's exactly what you're doing, right? You're transferring the risk to someone else. If my house burns down, it's on you, pal, not me. I paid you. That's transferring risk. Now, when we use insurance, the insurers themselves can also transfer that risk to someone else. They can use reinsurance companies. So an insurance company in one area may have a lot of exposure to a property in that area. An insurance company in another area may have a lot of exposure to a property in that area. And another insurer may have a lot of exposure to a property here. They can all go to a reinsurer that says, well, you can lay off some of that risk onto me here. Now, so they've concentrated risk position in each of these insurers, are transferring the risk to the reinsurer, who now has diversification across 3 sectors. So that's how reinsurance would work. So an insurance company can also transfer risk to another insurance company. Cat bonds do the same thing. These are called catastrophe bonds, where we sell bonds. We collect premiums against a natural disaster, let's say a flood or a tornado. And all of those premiums we collect, though they're going to be pretty high premiums because obviously it's a high-risk place, will pass through as coupon payments to the cat bond holders. And the cat bond, the catastrophe bonds, the money we raised on those bonds will be used to pay out any claims that we get. If a tornado hits, guess what? The cat bond holders are wiped out. They don't get their money back, and the money we raised in the bonds goes to pay off all the damage. So the insurance company's at no risk. It'll sell risk insurance to the holders of homes in a particular region, take all of those premiums and pass them on as payments to investors who bought these bonds. Other transfer devices, a surety bond, fidelity bonds, indemnity clauses. These are really to protect against your employees doing something. Now, the term bond here, that's used as a surety bond or a fidelity bond, these are more like bonds of good faith, as opposed to a bond with a stated coupon. It's not debt, it's just a promise, a bond of good faith. So when we think about employees being bonded, that's called a fidelity bond or a surety bond. Risk shifting. Now, once we've gone through risk transfer, we understand what risk transfer is. It means I have a risk, I'm going to completely transfer it to you. And I'm going to pay you a premium, and you're going to make me whole. Risk shifting, on the other hand, changes the distribution of the risk outcomes. So we're not totally transferring the risk, we're just changing the distribution of the outcomes. Now, it's hard to see the difference, and I sometimes have a hard time seeing the difference as well, that if I buy a put on an index, as far as risk management is concerned, I'm risk shifting, I'm not risk transferring. But in my mind, I think, but I don't have the risk anymore. If the market falls, I don't have the risk. I've transferred that risk to someone else. But if I transfer the risk to you, am I not shifting the risk to you? So if you're having trouble with risk transfer and risk shifting, so am I. I just say, okay, well, when I think of risk transfer, I think there's insurance. When I think of risk shifting, I think anything but insurance. That's the way I sort of delineate the two. That if I buy insurance, I've transferred risk. If I do something else that's not considered insurance, hey, I've only risk shifted. Typically derivatives. So whenever you're doing something with derivatives, even though we may call it portfolio insurance, by buying puts on the index, that's risk shifting in terms of risk management, not risk transfer. Change the distribution of the risk outcomes, typically using derivatives. These are forwards and futures. You get heavy into that at level 2.